Welcome to the Big Mike Fund podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in, because Big Mike has got the mic. Starting now.
Welcome to the Big Mike Fund podcast. I'm the Big Mike.
Mike Zlotnik, and today it is my pleasure and a privilege to welcome back my really good friend, Chris Miles with Money Ripples. Hey, Chris.
Hey, Mike. It's good to be back on again.
Awesome to have you back. How things are going? What's going on? We're getting this recording done in mid-October 25. So what's new and exciting in your world?
Well, new and exciting. We're about to launch our book, The Work Optional Blueprint. That's coming out here in, well, depending on when this airs, probably after the time this airs. So we actually have the pre-launch coming out in October, and then we're officially launching the book in November. So we're really excited to have that come out. That's my first official, real, actual book that I've done. I've done contributions to books. I've done an ebook that was like 35 pages long. This was definitely a big project that we've been working on for the last really year, almost year and a half. So excited to get that baby born.
It's harder to get a book out sometimes than to have a real baby. I have my book in working for 2 years now. Well, the second book, but it's a hard process because you write it and then you try to make it better and better, and things change and you make it better. So congratulations, that's wonderful. How would folks sign up to get a copy? Is there an easy way? What's a page sign up page?
Yeah, easy thing. You could just go on Amazon, obviously, and get it there. Obviously, you can go to moneyripples.com as well.
Okay, that's great. So hopefully it'll be a bestseller on Amazon and moneyripples.com. What is the book all about?
Yeah, so Work Optional Blueprint, what it's really about, it's about how to become work optional, which is really a term we refer to as when you have enough passive income coming in from your investments, investment income that's coming in, where you no longer have to work at your job. You work by choice, not by necessity. And so you really become work optional, right? It's like what Robert Kiyosaki talks about is getting out of the rat race. The thing is that, we hear about that, we read about it in Rich Dad, Poor Dad, but we don't really know how to do it. And in my story specifically, I actually did it the first time when I was 28 years old back in 2006. Came out of retirement in 2007 to teach people how I did it because I was so amazing. And then about 2007 through 2009, we hit the recession, and all of a sudden our business is starting to fail. My real estate's failing, and I went from millionaire to welfare, essentially, right? I was literally on welfare, getting food and things like that, and so I was struggling, and luckily during that time I was able to not just start over, but I had to start from really $1 million in debt and had to dig back out of that hole. I didn't go bankrupt, so I had to pay off that debt, build it back up, build up my portfolio to where by the end of 2016 I did it again. And so I didn't just do it for myself twice by the time I was 39 years old, but I've also had clients do the same thing over and over again with the same system and process. And so that's what the book really focuses on. It's about my journey, but it's also about how you can actually create that time freedom through financial freedom.
That makes a lot of sense. That's actually a wonderful journey. So let me ask you some tough questions, really, really tough. They're very relevant to the times. And I know you are anti-Wall Street financial advisor, or I'm not sure how you call yourself, but I remember anti-Wall Street, and then the rest is, unfortunately for all of us who are in the alternative investments, anti-Wall Street. The Wall Street is doing great. This is the crazy part. So we're kind of seeing there's been some struggles with alternatives and a lot of success with Wall Street, and people are incredibly complacent. It's almost like they don't want to do anything because things are going good with the stock market. And how do you get people to actually take action today? Because it's kind of like when the volatility is high and the stock market is not doing well, and people naturally are thinking, I need something better than this. But today it feels like it's the reverse.
Yeah. Well, I don't blame them one bit, because this is exactly what happens before there's a crash, right? Like, for example, understand my background. When I started, I was a financial advisor. I was a financial advisor selling mutual funds, securities for 4 years. I was all about Wall Street. And not only was I a financial advisor, but even towards the latter end of that, I was also a stock trader and a stock coach. I always teach people how to trade stocks and options and different strategies of how you can do it, and things like that. I always teach people how to do married puts so they could buy the stock and buy the put option, just like Mark Cuban did when he got bought out by Yahoo. And even though Yahoo tanked after Google came on board in 2005, still he had enough money because his put option protected it. So I'm no stranger to Wall Street at all. The reason I'm not a fan of Wall Street, especially right now, is that it's extremely overvalued, which what's happening right now is most people just don't care. They don't care about facts. They don't care about what's going on. And I'm talking about the general public and even the media, right? Which the media, by the way, anything the media says is pretty much going to keep you broke, right? Because by the time it makes news, you're already too late. So when you're hearing about gold, even right now, I'm not saying you're too late for gold necessarily, but the fact is now all the media is talking about gold and somewhat about silver, even though I think silver has more potential than gold does. But they're all talking about gold and everything else, right? Well, this is at the point where you're at the run up and everybody's talking about it. Well, I think this is what's happening right now is when it comes to the stock market, especially, and with the average saver and I wouldn't even call them investors, your average saver, right? The people that have mutual funds and 401ks, Vanguard funds, or whatever it might be. The problem is this, and I like what Alistair McDonald talks about, is that there's a difference between signal and noise, right?
That's right.
The signal is actually what you can hear when everything's silent. The noise is everything else that's going on. When you have all the social media and media talking about what's happening and you trying to turn on the news channels and the financial, especially even the financial news, you're turning on all these different things. You're hearing all kinds of noise. You're hearing about Trump and tariffs. You're hearing about immigration issues. We're hearing about, possible, inflation still sticky. We're hearing about the feds. We're hearing about government shutdowns. We're hearing about all this kind of stuff, right? Is there a recession or not? It seems like there's no recession in sight. Is unemployment really as bad as it seems, or is it worse? Nobody knows because they keep adjusting the numbers. Is the government even tell us the truth, right? I mean, all these things. Is the government spending too much money? We're going to too much debt. Is Social Security going to be okay? This is all noise. Yes, there could be signals within that noise, but the problem is because there's all this 24/7 news happening, which the news companies love, the media loves it, they're going to exploit it. And if you get sucked into that, you're going to get caught up in all the noise. And when that happens, what happens is that you freeze. You don't do anything. You're not proactive. You're reactive. And as a result, you start hearing all this stuff going on and you don't know where to turn. And again, I've heard this from clients all the time. They don't even know where to turn. They're like, well, I'm going to stay the course because if I go the real estate, well, it seems like real estate's having issues. What if I, go towards gold, silver, or crypto? But still, those things have been going up a lot. Stocks seem like it's okay. Everybody else is doing stocks. Maybe I'm okay. And people get lulled away into this real false sense of security, right? And that's what's happening right now. And I know what's bad right now when it's someone like me who knows these things, someone who's like, no way am I going to touch it. And I know other stock traders that don't want to touch the market right now either. And still, it's hard not to get FOMO, right? That fear of missing out. And if you know that you're getting FOMO, and if I'm getting FOMO about maybe I was wrong about the stock market, maybe I should have been it the whole time. Maybe it would have been better than real estate, especially these last few years. Ooh, that's been rough. And that's when you start saying those things, that's exactly when you know things are about to shift. Because when I start getting FOMO of something, that's usually when it's already at the tippy top, right? Especially when I know otherwise. And the problem is that most average people are going to find themselves, because when the market does drop, it drops hard and fast, right? It drops super fast. I mean, even look back at 2007, it really didn't start dropping until about the latter part, like the end of 2007. We started to see that happen, fourth quarter. But then it popped right back up a year and a half later. But in that year and a half period of time when it went down, the stock market lost about half of its value. So by the time most people finally have the courage to say enough's enough, they sell out at the bottom. They're too late, right? That's what average people do. Smart people, the people that actually say, you know what? I'm not going to be like every other American that ends up being broke. I want to do something faster. They say, screw the FOMO, screw all that. The problem is that even though they know, there could be something better, right? They still stay there. So a smart investor will say, I'm going to bail out now. I'm going to take my profits and run now, because in the last few years and beyond, and then really the last 16 years, it's been this nice, huge bull run. Why not take your chips off the table now? And it doesn't mean you have to pull out all of your money out of the market. It might just mean maybe I take a good chunk of my chips off the table, leave a little bit in, because what if it does go up? And when we're doing stock trading, we would call that scaling out, where we would take a position and take some of those profits out. Because if it was still going up, there's no evidence of going down yet. We would just take some of the profits, right? We'd take enough to maybe even make a gain, and then leave the rest to ride. I did the same thing with crypto. Back in when it hit the previous, back in was it 2017, it hit a high of $20,000 on Bitcoin. I remember I was telling everybody it's about to crash, and it did. And it came crashing down. And when it got down to about $6,000, I said, you know what? I'm going to buy in now. Even though just the year prior, I told people, don't you dare buy that stupid Bitcoin. I went ahead and bought it because I saw an opportunity. Granted, it did go down a little bit further to about $3,400, but then it popped right back up. And so when it got up to roughly about $20,000 again, I said, you know what? I'm going to make sure I take all the money I invested plus 20% gains. I'm going to take all that out and let the rest play. Because then I knew I made a 20% gain, and even if it went to zero, I didn't lose a dime. Why can't you do that in the stock market? Why couldn't you say, you know what, I'm going to take a lot of these chips off the table. I've made a lot of money, and maybe I could put it somewhere else where it can actually a place where people haven't been saying where it is. Because if everybody's telling you that one thing is good, that's when it's not good. That's when it's too late. You want to go to the places where people don't think it's good anymore. That's where you buy the best deals and find the best growth in your investments.
Yeah, agreed. Be greedy when I was a fearful, be fearful when I was a greedy. Warren Buffett, this wisdom applies even more. If you follow market cycles, this is exactly what happens. Howard Marks, the risks have increased significantly with all the price growth in crypto, stock market, Magnificent Seven, AI, super boost. All these leading AI companies. They're called, it's the Googles, it's the ChatGPTs, it's the
Oracle,
all these. Anyone with anything that touches AI, what do they call them? Accelerators or AI. They're leading the space. But Ray Dalio said recently, it reminds him of .com boom and bust. This feels like 1999. You're right. Give it a little more time, and a crash could be imminent. And this super race against China, super race where win at all costs. There will be winners and losers, and the prices people are paying for these assets are in stratosphere, and they're expecting growth to be faster than anything imaginable. Mm-hmm. So we share this thought that at least people should consider diversification, whatever you want to call it. But rebalancing, diversification is something that folks should consider, even if they love whatever they have in their portfolio. It only makes sense to diversify to whatever reasonable degree, even to the point, I think I've said this many times, but a friend of mine used to be in CG, I'm just not going to mention his name, called me 10 months ago or about a year ago and said, I got so much crypto, I can retire many times over. What do you got in real estate? Right? That's the right thinking, right? Mm-hmm. I was like, yeah, thank you for calling me, because we got some phenomenal opportunities today in a beaten up market, and commercial real estate is truly and genuinely beaten up. So the opportunities today for the new capital are just phenomenal on a risk adjusted basis. At the same time, people are still ultra complacent. And he struggled, just to be very clear, he struggled to sell a little bit of the crypto and to diversify that little bit, which is not little bit of money. It's actually a pretty sizable check into real estate deals, because it's a mindset. It's a complacency. It feels like a bull run, but when will it end? And all these, exactly the noise versus signal. There's a lot of noise and really big picture conversations about national debt and the fact that you can't trust central governments, central banks. All that said, we're still a lot more likely to see deflationary pressures than ultra-inflationary pressures, as crazy as it sounds, because AI is actually highly deflationary in nature. If you think about it, it's going to eliminate a bunch of jobs, and we may have needs to cut way faster than to deal with these ultra, high inflation. Who knows, right? But let's continue. So I love your angle. I like how you put it. That folks need to actually be contrarian. I don't know how else to put it. Because if you follow mainstream, they lead you straight down the road to a cliff. Until you get to the point of a cliff, you don't know. It feels like you're still climbing, you're still doing well, and what's ahead? It's a cliff. So, what's new on the infinite banking side? Anything new happening? Anything interesting? Are now the days as good as before, better, or it's been around so long and it's such a steady eddy that it's good? It was good yesterday, it's still good today.
It's kind of the latter for sure. I mean, it's one of those things that doesn't make a lot of news, which is kind of why I like it, right? Now, granted, that being said, because interest rates have been higher for longer, dividends have come up. Not huge amounts, but they're creeping up, back upward again, right? And this is especially important where this is what I'm seeing. I'm seeing a lot of people, as they're talking about, like you said, diversifying themselves, right? And where do they diversify? And if you look at Warren Buffett, again, heralded as the Oracle of Omaha. By the way, he's never an oracle until after a crash. And then people call him an oracle. But before the crashes, they think he's an idiot, right? They think he's missing out. He's old. He doesn't get it. And then also when they don't have money and he does, they're like, oh, that's why. Well, right now, Buffett's got 30% of his portfolio, the most he's ever had in cash, over 340 billion sitting in cash right now. Now, he has been starting to buy slowly, like he's bought into some energy, energy type companies and things like that.
Didn't he buy a petrochemical company? They just announced that he was from a petroleum company, bought their division because they needed liquidity, and he was already a shareholder. He decided to basically buy their great other business, but he's not doing it in any heavy volume. He's basically, that was like a $10 billion transaction, and he has 300 billion in a bank, right? So he's transacting, but just in a small manner.
Yeah, it's interesting because I'll hear normal people, even people that have been good disciplined savers and think they know a little bit about the stock market. They're like, oh yeah, I've got my Apple stock, I love it. Well, he sold off his Apple stock last year. Bank of America, he sold off, right? He actually bailed out Bank of America during the last recession. That's why he got such a good deal. He's been selling that off, right? He's been selling out of a lot of the tech-based type companies, which is what everybody's telling you to get into, right? So he's doing the opposite. And people will think he's an idiot for doing that because he's missing out on these returns. Yet his returns actually year to date have exceeded the stock market, even with all this cash on hand. And one thing that's interesting, when he bought that petroleum company, he actually didn't use his own cash. What he did? He actually has ownership in insurance companies. And he did what's called, he bought it on float. Very similar to infinite banking that we teach about, where you have your cash tax-free savings account, right? And you can get a line of credit against it. Well, Buffett can do the same kind of thing, but he does it on a bigger scale. He literally owns insurance companies that they'll have money just sitting there, money that they can invest and do things with. They'll have it sitting there because they know that eventually they might have to keep some money on hand in case there's claims, right? Whether if it's auto accidents, it's like auto accident claims. They keep some money on hand just in case. You've got life insurance companies that they wait for people to pass on, but they have all this money sitting around that they could do something with in the meantime. And so they can invest it and do stuff. Well, guess what? Because Warren Buffett has ownership in those companies, he literally has his own piggy bank with those insurance companies to go borrow at 0% to then go use their money to go make money off of it. So yes, he has a loan against it, but he's not paying any interest on it, right? And then he's going and making money off of it. This is kind of somewhat similar to what we teach with infinite banking, where you can do the same thing. You can literally have money. Now, the difference is this, is that, he's obviously taking that money out, right? And doing it as a line of credit, and he's not paying interest, but he's not really earning the interest other than on his investment. You have an advantage over Warren Buffett because you can actually be earning interest on your money and then get a line of credit from the insurance company and then still go make money with that money. Because that's the thing, you can withdraw your money, but if you withdraw your money, you stop earning interest in that account. But what if you left all that money in there? You just get a line of credit with the insurance company, you borrow from them at, again, a very low rate, and then you use that to invest. So not only are you making money in the investment, but you're still making a little spread over here too with the money they're paying you. And so that's the thing that's kind of awesome. But I'll tell you, even though that's a really cool strategy, I'm still telling people, hey, listen, if you're thinking you need to be in cash right now, for example, a lot of people are wondering, what if I do pull money out of the market? Where do I put it? Because I'm kind of scared. I don't know where to invest it quite yet. Well, a great temporary holding place could be in your life insurance, where it's earning right now. It's 6% a year, tax-free. Just so you're aware, Vanguard predicts that the next 10 years, the S&P 500 will only do between 2.8 and 4.8% average per year for the next decade.
That's an amazing prediction. Usually the Wall Street firms avoid this type of prediction because it's not in their best interest to market. In order to market their funds, you want to sound rosy and optimistic. And to predict that kind of low rate of return, you have to be a very, what's the word for it? A genuine, realistic, conservative player, because they it's a confirmation bias. They believe, and then they select the news and they follow the views that support their own business, the Wall Street business. So rarely ever you're going to hear that kind of prediction. That is fascinating. Yeah,
it's true. Like, it has to make you wonder how bad they think it's going to be over the next 10 years. But they obviously know it's like a airplane that you even if you haven't seen it in real life, like at an air show, if you've ever seen in the movies when an airplane is going vertical, right? It's trying to climb, and pretty soon you start hearing it sputtering. And it's still climbing, but it's sputtering, and then it's going to stall, and then it falls, right? It's the same thing that's happening in the market right now. They know that the gas is out of the tank. They know that it's gone up so hard, so fast for so long that you have to have amazing news just to keep the market going up. Or in this case, no news is good news, because that's why Wall Street's been going up with the government shutdown, right? Because they're like, well, hey, I don't care. I didn't hear anything. Nothing's going on because government shut down. There's no new numbers coming out. We're fine. Buy. But even that they're buying, it's very slow. It has all this upward resistance. And so that's where I'm just telling people, like, you got to be careful. You really got to make sure that you don't have all your chips in literally blue chips or tech heavy things like the S&P, which, by the way, the top 10 stocks of the S&P make up 40% of the S&P. You are no longer diversified in the S&P index.
Yeah, it's the Max 7. The Max 7 weight in S&P 500 is insane. I mean, essentially,
it's about 30% for the Mag 7. Top 10 is about 40% right now.
Yeah, I mean, great minds think alike, and I agree and concur with you. This is the time of extreme danger and extreme caution and elevated risk. And of course, we don't know this party can continue, but it feels like I'm a huge fan of all these investment gurus, Warren Buffett, Ray Dalio, and Howard Marks. And I've been re-listening to the Mastering the Market Cycle by Howard Marks. It's a great book, and you just the things that are happening right now is so many real basic common sense indications. We are approaching a relative peak. The cycle always continues. There's no start or end, but we are approaching the peak, and it's exactly the behavior. And on the other side, we're heavily at the bottom. The opportunities in commercial real estate are so attractive. It's almost the fear is high. The liquidity is low. It feels like everything is falling, but that's exactly the best time when you got to open your mind and just, like you said, take some chips off the stock market table and put it into what's relatively cheap. So we'll see what happens, but I don't know. It's kind of like people are sick and tired of listening to this. You tell them this so many times, and they're not paying attention until it happens, and then suddenly kind of people learn afterwards, but until it happens, it's very difficult to convince. We're out of time. Chris, appreciate you. This was wonderful to have you back. Always love to have you back. And final, any final thoughts very quickly? How would folks reach out? moneyripples.com, any other websites?
Yeah, final thoughts is just that there's always hope, right? And there's hope, especially if you're not following the mainstream. Mainstream savers end up being broke later on, right? They're the ones that become asset rich, cash poor, don't know how to create any real financial freedom. And they're the ones that suffer the most when there's a market pullback. You have an opportunity to make a choice right now. You don't have to be the victim of circumstance. You can take control of your own life. And yeah, definitely, if you want to do that, feel free to follow us at moneyripples.com. We also have our Money Ripples podcast. or social media. It's all at Money Ripples.
Thank you, Chris. Appreciate you, and have a wonderful fall. Enjoy the colors of the.
You too.
Thank you.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike's slot name. Keep listening and keep investing Big Mike style. See you on the next episode.